Good afternoon. Well, there's been some big news. Came out yesterday. Apple hit $1 trillion in market cap. First company in the United States ever to do that, public company. And what's amazing is that, again, the first time, but I was thinking, do people know what market cap is? We throw that out. But market cap, well, I'll let you explain market cap.
Yeah, market cap, again, I just want to say too, $1 trillion, that's a lot of dollars.
Yeah.
I mean, really speaks to how big the volume is there. Got to point out too, had a little bet going back a couple weeks ago.
Oh, I forgot that. Well, time's up.
Yeah. You thought Amazon, I thought Apple was going to make it first, and they did. But let's get back to what market cap is. What it looks at, it's the stock price times the shares outstanding. Mm-hmm. And what it does is it kind of gives you a good understanding or a good idea of what that company is really worth. What's the true value of it? So understanding the market cap of companies, so important.
Yeah. Also, too, another way is by equity, assets minus liabilities, give you owner equity, so different ways to value about market cap. We'll make sure you understand that. And again, I am glad that Apple did hit $1 trillion first over Amazon. But let's talk about people's concern now. Oh my gosh, it's so expensive. Is this like the tech bubble? Is it now going to falter? The answer to that question is no. I mean, and let's compare this to the year 2000. Year 2000, crazy things with Microsoft, Cisco. We know some of the earnings that they were paying back then.
Yeah, it was just ridiculous. And I think it's just that psychology of, oh my gosh, Apple's at $1 trillion now. But that's without again understanding what is the true value of it. We talk about understanding the PE ratios, the forward PE. Microsoft traded at 59 times earnings back in 2000. Cisco, 179 times. You better sit down. But kind of crazy. There are still some companies out there today that are trading around those levels. Yeah. And one other one that's still around today, very prevalent, Intel, 126 times. Just as a side note, Intel and Cisco still are not at those levels when they were at during that lofty time period.
And this is why we warn you about paying too much for a company. And again, Apple trades around, 16?
16.
Yeah, which is below the S&P 500 earnings as well. Also, the fundamentals of Apple are very strong. Again, we talk about great valuation ratios, a great balance sheet, their sales are up, earnings are up, cash flow. Fundamentals of Apple still very strong, and you're not paying much for those.
It's just a great company. And we always tell our clients, though, we like Apple, but we still have caution. I would never put 100% of your portfolio, even more than I would say 18% of your portfolio in this one company. You think would be crazy if you came over to us and it was a different company. But just kind of talking specifically with Apple, there are some things that could go wrong.
Yeah, and that's what we were about, is that Apple, again, they are, I kind of call them almost a one-trick pony. About 64% of their sales come from the Apple phone, not including products and services that are tied to the Apple phone. You've got to understand the business. We've seen companies like this before, and we love Apple, but you got to be careful. I remember the Motorola Razr. I remember the BlackBerry and so forth. They went down, so those are things concerned about. And also, too, they have a lot of cash, but there could be problems with that as well.
They should buy Tesla, right?
Yeah, right, there we go.
That's what we're concerned about. They have so much cash. We'd be very concerned if they took an acquisition that really took them out of their realm, what they could really focus on, and just some things to be cautious of. Just because it's great today doesn't mean it's going to be great 10 years from now.
Exactly. So I hope that helped you out. Again, tune in the radio show tomorrow morning on AM 760 KFMB, the Smart Investment Show, 8 o'clock. Talk with you soon.